Hello. Okay. Hello everyone. Welcome to Offset 24/7. My name is Niharika Valia Bhatnagar and I am with you with the area of AFM. I hope I'm clearly audible as well as clearly visible, everyone. Okay. So what are we going to do today? I'm sorry. The Just a moment. Okay. Good morning everyone. Actually, it's now afternoon. We normally meet in the morning at around 7 a.m. for this particular class, but today we are meeting in the afternoon. So, good afternoon and welcome to Officer 24/7. My name is Niharika Valia Patnakar and I am with you with the area of ABFM. Today we are talking about CIIB, ABFM, Module C. I think the series started a few couple of weeks back. Done with the entire module A, done with the entire module B, and currently pursuing the module C. First of all, if you had been reviewing these specific classes, then please go ahead and like these particular sessions. Your responses are very important to me because ultimately this is a source of motivation because someone is getting any kind of benefit out of these classes. It's one of the first things where the hard work that we are putting in is getting materialized. So that's the basic thing that I think we should look forward to when it comes to our classes, right? Then till now we are done with entire module A, entire module B, and in the module C we had started with the area of discounted cash flow valuation. Cash flow valuation, discounted means we are talking about the present value, everyone. We cannot rely on, if I said that I'll receive 10,000 rupees in the second year, in the third year, in the fourth year, the value of the money is changing every single year. So obviously there is a variation and I have to consider that variation. And if I'm not considering that, the time value of money would mean that the 10,000 that I'll receive 2 years later is going to be the same, then my ideology is wrong. I have to consider the fact that yes, over the period of time, the value of money would decline, and at that point of time, and if I receive 10,000 today, there is a difference between the two. That's what we talk about discounted cash flow valuation, everyone. In terms of discounted cash flow valuation, what do we talk about? Acha, give me a moment. I think this question would require this. Acha, everyone, when making valuations, the market based approaches should not be used. Market based approach means what is the value of the organization in the market itself. है ना? So what will we talk about this, everyone? When the size of the company is insufficient, or when company's assets are lower than its liabilities, in the event there are significant and unprecedented shifts in the market price, or when it is challenging to provide an accurate estimation of the realizable value in the event of a going concern. When we talk about the market based approaches, I believe if the market is changing very frequently, how will we rely on it, everyone? In the event there are significant and unprecedented shift in the market price. The market price is changing so frequently that if I rely on this market price, then we would get more or less stuck in that particular area. How will we work at that point of time, everyone? Won't it be too confusing? Won't it be something that we'll feel this is unpredictable about? Matlab, I personally feel that if the market is changing so much, then even if we want to find a trend, we just can't find a trend. If we cannot find a trend, we should not rely on that particular portion, don't we? So, in this case, when we talk about the market price, it should be in a situation where the organization is having a stability and they can see what is going on in the market with themselves as well, because you can control your organizational environment. But what about the market? When COVID was hit, entire world was hit. The markets were hit. When any war happens, if, for example, the Israel-Palestine war, and when we talk about the Russia-Ukraine war, the entire country's market prices had been under a major uncertainty. You cannot find a specific fashion or trend in terms of the movement of the prices. They are just moving here and there as per the requirement. The demand goes high, the price goes higher, right? That is the particular scenario. So then this is not reliable when you see a lot of speculations around. The discounted cash flow method of valuation is based on the discount for the future that is anticipated and is likely to be earned. The company's valuation or anticipated cash flow along with discount rates or the company's potential for earnings. Everyone, the discounted cash flow valuation is based upon what? I told you when we talk about the discounted cash flow valuation, we are worried about only and only one thing. What is it, everyone? We'll be worried only and only about one thing, that is whether the books of accounts are prepared in such a way where we are looking at the values not from the present point of view, but we are looking at the things from the point of view of future. Okay? We are looking at it that what would be the value in the future and how do we look at it, right? So in this case, what's going to be the answer, everyone? A discount for the future is that is anticipated and is likely to be earned. The company's valuation or anticipated cash flows along with discount rates or company's potential for earnings. You cannot find out the potential for earnings, but yes, you can anticipate the cash flows along with the discount rates. Matlab, you know that you are going to have 1000 rupees minimum in the upcoming year, then it will grow further. Once this business starts growing, then it can become 5000, then this can also become 4000 in the upcoming future, and you find the discounting rates here, and then you multiply and find the discounted value. This is the method in which they are using the discounted cash flows. Under the discounted cash flow valuation, which of the following is typically employed as a discounting factor, everyone? Cost of equity, then cost of debt, annuity factor, or overall cost of capital. What's going to be the answer? Under the discounted cash flow valuation. Everyone? Under the cash flow valuation, what is it that will be coming there? Chali, then let's talk about the answer as well. The answer is overall cost of capital. You just cannot take only equity, only debt, or only preference share. Won't it be wrong? Reason? Think about it. If I consider only equity, only debt, or only preference share, their cost, the cost that we have to incur to maintain these people, है ना? Then what will happen? We have a blend of these three. In many organizations, you will find equity and debt. In many organizations, you will find all the three. That is equity, debt, and preference shares, because many organizations have started getting the preference share for their organization as well. So technically, when we have these, why don't we use the overall cost of capital? This is nothing but WACC. In WACC, you take the weight of equity into the cost of equity. You take the weight of debt into the cost of debt. Then last one is when you have to add, this is weight of preference share into the cost of preference share. So this is based upon the weighted average cost of capital of the entire process. This is what is considered, everyone. PV indicates the value in use, the value of the cash flows expected in the future, or the value computed using the internal rate of return, or the present value which a buyer is willing to part with. Present value is basically the value that would be today. है ना? In this case, the answer would be the value of the cash flows expected in future. ठीक है ना? We are looking forward towards the value in future. Because पता है basically how do we find the present values? We find it this way. Let's use the compounding formula. In compounding formula, how do you find your amount? Amount is equal to principal 1 plus r raised to power n. Now they are giving you the amount that you are receiving in the future, maybe after 2 years, 3 years down the line. So we will take this amount and we will divide it by 1 plus r raised to power n. this particular portion will go, this was multiplied here, it would be divided there, and there it is P. So the present value can be found out if we eliminate the interest portion from the amount. है ना? That is what we will choose. What is the basic thumb rule for determining the what constitutes a moderate growth rate? Within 2 to 5% of the growth rate of the economy, within 5 to 8% of the growth rate of the economy, within 8 to 10% of the growth rate of the economy, or greater than 10% of the growth rate of economy. Moderate growth rate, everyone. For example, if we talk about India, what's happening here? Moderate growth rate. Moderate is not very high, not very low, correct? In this case, the correct answer is going to be within 8 to 10%. Okay? It is between 8 to 10% of the growth rate in the economy is moderate. Done? Then, oh, the answer is visible. Just a moment. What are the three main approaches for estimating the growth patterns when valuing a company, everyone? What are the three main growth rates? Stable growth, speculative. Speculative is basically which goes up and down at any point of time with the change of pricing. Then declining growth, it goes down. Then consistent high growth, low, moderate growth, and declining growth. Then stable growth, two-stage growth, and three-stage growth. Then is organic growth, inorganic, and hybrid growth. Since you have seen the answer, what would it be? The answer would be C. Growth rate, two-stage rate growth, as well as three-stage growth. The growth factors and the particular topics, when we talk about the growth, there are certain methods through which you can actually find it out. Okay? They use different models in this area. And consider discounting rates. That means they are considering the portion of present values here. Now done? Which particular organization, what characterizes company with stable growth, everyone? Earnings and revenue both significantly growth significantly faster than the in economy. Then is earnings and revenue growth equal to or lower than the nominal growth rate of the economy. Then is earnings and revenue growth slightly faster than the economy's nominal growth rate. And the last one is inconsistent growth patterns. What would be the answer, everyone, in this case? When we talk about the company with a growth rate which is stable, the answer would be B. The earnings and growth rate which are equal or lower than nominal growth rate of the economy. Okay? The answer is B, everyone. Why do high growth rate exhibit in terms of earnings and sales? They have nothing to show off. Till the time these organizations are growing further, they will always talk about the money they have received. How do they tell it? Because they are showing their books of accounts and they are showing their sales. This is enough for showing that the company is a huge growth company, right? Expansion at the rate equal to the nominal growth rate of the economy. Expansion at the rate slightly faster than the economy's growth, or examination at a rate significantly than the nominal growth rate of the economy. And the last one is the stable growth patterns. What is it when we talk about the growth rate, which is high growth rate companies? And what do? They normally expand and work a little faster than the others. Why? Because they are fast paced moving companies. Done, everyone? Here comes the next question. Which growth pattern is suitable for business growth at a stable rate? As I told you, there are different models. So according to you, go ahead and choose the specific model, everyone. Two-stage discounting cash flow model, three-stage, and the last one is the steady growth rate model. अच्छा ठीक है. Let's talk about which growth rate is weighted to the rate of stable rate in the two-stage discount cash model, or three-staged discounted cash flow model, or then is steady state models assuming a constant growth pattern. What would be the answer accordingly? The answer in this case would be steady growth model. You're assuming constant growth. Even in the book, they have given assumptions regarding the same as well. The assumptions should be read by you because they can ask you questions based upon this area. Done, everyone? Let's move on to the next question. What are the three criterias of the straightforward application of the discounted cash flow approach or discounted cash flow method? In this case, positive present cash flows, and then we talk about accurate forest of future cash flows and steady risk profile. I'm sorry. Then we have the present positive cash flows and accurate forecast of future cash flows and steady risk profile. Then is negative present cash flows, unpredictable future cash flows and fluctuating profile. Then we have present cash flows, conservative forecast of the future and dynamic risk profile, and last is negative cash flows, accurate forecast of the future as well as steady risk profile. In this case, when we talk about straightforward application, they apply it when organization is all positive, they have accuracy, and they have a steady risk profile. If the risk is too high or things are so unpredictable, can you rely on the model? Matlab, personally, I would say, how will I rely upon the model when it is not giving me any conclusive result? You know, that's one of the basic things that we are always scared of, isn't it? The correct answer is A. Positive cash flows, accurate forecast of the future. Next point. What's the next point, everyone? The next point is, oh, the answer is also visible. What are the some of the models in addition to enterprise and equity DCF model that can be used for valuation? Dividend discount model and economic profit model, inflation adjusted and discounted, as well as we are talking about residual earnings as well as maintainable profit, or market share model or discounted profit model. Equity is always the residual earnings. They are the scavengers of the organization. They hunt upon what is left in the organization and then they maintain. But for this, whatever is happening, if there's acute losses, then they face a lot of problems. This is basically done in order to maintain the profits. So that is, it is basically the residual owners as well as maintainable profit model. The answer is C, everyone. Okay. What is one of the earliest discounted cash flow models that is considered as dividends? Considered dividends, everyone. Adjusted present value model, economic profit model, residual earnings model, and maintainable profits model. Which one of the following is the earliest one? The oldest one. What would it be, everyone? The oldest one is adjusted PV model. This is still used. ऐसा नहीं है this has been out of use at all. This is still in use.
Good morning, everyone. Welcome to Officer 24/7. My name is Niharika Walia Patnagar, and I'm with you with the area of ABFM. And we were doing the module C. And in the module C, we had started with the topic of discounted cash flow valuation. Discounted cash flow valuation is a specific method under which we find the time value of money of cash flows. है ना? That is required. If we don't do that, how will we actually find out whether the money that we are using would be helpful for us or not? The context of using time value of money is that we have future cash flows, we do not have present, and then from the future cash flows we have to find the value as per today, right? If we have to find the future value as per today, then obviously we cannot find the futuristic value without adjusting it. And that is what the discounted cash flow valuation talks about. What is the primary source of cash flows for equity investors in public traded companies? Interest payments, dividends, principal payments, or preferred dividends? What would be the answer, everyone? First question. Primary source of cash inflows. Sorry. Is it interest payments, dividends, principal payments, or preference dividends? When we talk about equity now, equity gets dividend. So in this case, the correct answer is dividends. Acha everyone, if you like this particular series, then please like it and share it among your peers as well, because I think this is a source of motivation for any faculty who's working at on these entire series. We are covering the entire syllabus. Uh, if you have seen, the module A is complete, module B is also complete, and currently we have just started with module C, and we are on the second chapter of the module C. And first of all, the most important thing I should say is save the particular playlist of the entire series, so that you would remember that the entire modules are covered chapter wise in this series, right? So on the last day, you can just look at all these questions quickly, or just a day before the 2-3 days before the examination, you can revise this portion, right? Now look at this question. The financial models that use dividends are known as FCFE discount model, FCFF model, dividend discount model, or cash flows to equity model. Dividends are given to the equity, so technically this is dividend discount models. What is the portion of dividend that people are going to receive over the period of time? Because these people receive the dividends, na? Equity shareholders share in the business is always dividend. There is nothing else that helps them, isn't it? Okay, the financial models that use dividends of cash flows. Oh, we are just done with this question. Dividend discount models is the answer, है ना? अच्छा, next question है. What does FCFE stand for in finance? Free cash flow to equity, financial cash flows to equity, firm cash flows to equity, or future cash flows to equity? When we talk about FCFE, this is free cash flow to equity. मतलब after making the payments to all the others, मतलब debenture holders has to be paid, preference shareholders has to be paid. When all these people are paid up, then whatever is left is kept for equity. ठीक है? Then it is called FCFE. And when we talk about FCFE, we are looking at it over a period of years. And then we will measure the same point, NPV, find the net present value. Once you find the net present value, you can find out whether it is helpful for this organization or not. If it is positive, then accept. If it is negative, then reject. Next, how is free cash flow to the firm calculated? Subtracting interest and preferred dividend from net income, adding FCFE and cash flows to the lenders, subtracting net investment required for growth from after tax operating income, and subtracting dividends from net income. How is FEFE to the firm, everyone? FC, acha, this is FCFF. Oh, this is free cash flow of the firm. This is the money that the entire organization is making, not to the equity only. Na? In this case, they are considering the entire organization. So in this case, what do you do? Preferred interest and dividends are not removed. So this is wrong. Adding FCFE and cash flows to the lenders, no, this is after the payment to the lenders. Subtracting net investment required for growth from after tax, acha, this is true. You will keep a part of it for reserves and surplus, you know, whatever you want to keep. In our book it is written as internal accrual. The answer is subtracting the net investments required for the growth from the after tax operating income. Operating income is the income that the business is making. है ना? So this is operating income. Next point, why might the cost of debt be lower after tax are taken into account? Simple reason, everyone. You take a debt. You start making your project for which you have taken the debt. This will increase your income. You will still just have to pay the fixed rate of interest. He cannot say that, Arre, you have started making so much of money because of me. Give me more money. He just cannot say that. You know? Now, I take a debt. The project started. I made good income. And from this income, there is no role of equity here. But the company has started making a lot of income. And this is where equity is going to expect that where is my increased share. Because now the company is growing. If the company is growing, I have the right to receive the money in future. So if I have the right to receive the money in future, I should be given that preference. Interest expense are deductible from tax income. है ना? Then dividends are deductible from tax income. Debt is not subject to taxation. It is subject to taxation. This is obviously wrong. Principal payments are deductible from the taxable income. No, this is not the point. But the interest is allowed. In this case, what happens is, first of all, we just have to pay the interest. And that too, we can cry in front of income tax department, hi, this is an expense. You pay good amount of dividend to equity. Then even equity is indifferent. This is still not an expense. So isn't it better that we take debt where we get the benefit of interest and expense and we don't have to pay more if the income goes higher, right? So the answer here is interest expense are deductible from the taxable income. If the income increases, the debenture holders will never cry about it, that we need more money. They just know that other than the loan, they have no other right. But the exceptional case is equity. Equity is going to come after our lives, that they need their money. है ना? Equity shareholder will not leave the organization. How is diversifiable or market risk used in estimating discount rates for investments? It is ignored in discount rate calculations. It is used to estimate the risk premium. It is used to calculate the cost of equity. It is considered in determining the cost of borrowing. What would be the answer, everyone? It is a non-diversifiable or market risk. If it is a market risk, the market risk is something where you get risk premium on it as well. For this, they use the CAPM model, capital asset pricing model. Then, under this model, you receive a risk-free rate of return. This is the minimum that you're going to receive, plus your sensitivity analysis. This is beta, your multiplier, and then we have your market rate. You remove the risk-free rate. This is risk premium. This portion is called risk premium. It is used to estimate the risk premium. How is the cost of equity calculated according to the models which have been discussed? Okay. By considering only the risk-free rate, by adding a premium proportional to market risk to the risk-free rate, by subtracting the risk-free rate from the expected return, or by ignoring market risk in calculation. How can we find it, everyone? So we have just did that part. If you take risk, then you will add the premium. Acha, isn't this the same question? No, similar. This is actually similar. By adding a premium proportional to the market risk. Always remember, higher the risk, higher is the return expected. That is the only reason people put money into risky organizations, because they have expectations that they will soon be receiving more money. Otherwise, why would someone put money into something where it would be difficult for them to earn? What is fundamental concept of valuation that analysts should adhere to? Ignoring market values, indifference between purchasing and selling an asset at fair value, using book value weights, or ignoring default risk. What would be the answer? The fundamental concept of valuation. The fundamental concept of valuation is basically the price at which both the buyer and the seller are willing to purchase it. That is what we call the fair value. It means we are looking at both of them. We are not looking at from the point of view of the purchaser or looking at it from the point of view of the seller. We are looking from both the point of views, because one would want to buy, so he would like to pay the least price, and the one would like to sell who would like to pay for the maximum price, isn't it? So that is indifference between purchasing and selling an asset at fair value. What is the challenge in estimating the expected growth in future cash flows? Lack of historical data, uncertainty, predictability of past growth, or market volatility, everyone? What's the answer? What is the challenge in estimating the expected growth in future cash flows? Uncertainty. The problem is uncertainty, everyone. The problem is that the future is so uncertain that even if we want to, we cannot eliminate the portion of uncertainty. You know? So in this case, this is the problem of growth. Done? Next question. Why should the results of growth rate appraisals based on the company management or consensus estimates be questioned? Lack of expertise, inherent bias in the resources, high level of accuracy or transparency issues. What would be the answer? The problem is lack of expertise. Now you get experts. Consensus, basically, people have bias. I think if I don't like the particular person who has been dealing with it, I don't care whether he's right or wrong. I would just impose the fact that according to me, this should not be happening. This is the ideology now. People will impose their ideology, isn't it? This is inherent bias. This is called inherent bias in a resource or in the sources. So while taking decision making, it might turn out to be um, unfavorable for the organization because it's going to give you wrong results. What potential impact is mentioned regarding rent control to the anticipated growth rate of the cash flows in the real estate? Increase in value, no impact, decrease in value, or stability? The answer is decrease in value. Why? Let's look at it. When we talk about when we are trying to have a rent control, everyone, what will happen? If the uh, if the rent will grow further at a very higher pace, overall people will try to move away from that organization. This is one particular thing that you will always find. Higher the rent, people are feeling that, Arey, we cannot afford this particular place at all, isn't it?
Good afternoon, everyone. Welcome to Officer 24/7. My name is Niharika Valia Bhatnagar, and I'm with you with the area of ABFM. I hope I'm audible as well as clearly visible, everyone. Kindly let me know about the same, and if these series are helping you out, then please go ahead and like these particular sessions and let me know about the doubts that you are having or anything that you would like to share regarding the classes. I'll be there in the comment section. So please let me know about the same. Acha, what are we going to do today? We're done with the module A, we're done with the module B. We're looking forward towards module C. So what is it about? So we're going to talk about other non-discounted valuation models. At this point of time in this series, we're talking about other non-discounted cash flow valuation models. Other discounted non-cash flow, non-DCF valuation models are basically those models which are linked with the areas of um, relative uh, study of one particular valuation with another. We're talking about PE multiple, PS multiple, PB multiple, all those kind of models, but it doesn't use the time value of money in it because according to that, the time value of money is not something they're looking forward to because time value of money is already taken up by the discounted cash flow technique. So since it has been taken up by the discounted cash flow technique, then these models are somewhat different from that one. Acha, before I proceed further, I hope you would have seen our sale is live right now. So have you taken up the courses yet? And if you haven't, then why not? Okay, let me just show you before I proceed further because this is the opportunity which you should not let to go at all. Okay, so let's go ahead and find out. Okay, this is our website www.adda247.com. Go on to the area of JIB and CIB. Choose the particular exam. This is our CIB June 2024. As you can see at this point of time, CIB Mahapack 2.0 is having double validity. Not only double validity. Click on the area of this area. Click on the area of buy now. Use the code Y use the code Y541 and you will get this particular Mahapack. This is for 12 months and you're getting it for 6823.95. So if I talk about this amount of 6823.95 divided by divided by 12 months, this is effectively 568 rupees. If I go for a Netflix, it would cost me around 649 for the multi-user and this would cost me around 568. So isn't it a better investment? You'll just be spending around 500, 600 rupees and you will be getting the entire CIB. When we talk about entire CIB, all the 5 optionals are included. You don't really have to choose between the one which you want to watch. Then at the same time, you have all the 4 compulsory subjects in it, the test series, and then we have all the ebooks. Then other than the ebooks, you also get other options as well. Live classes, recorded classes, both are available. Previous batches that have ended, any specific further batches that we are going to include further, they are also a part of it. Okay. Then what else do we have? All these things are already included. Other than these, you will also have the opportunity to look forward towards the era of these whatever we are coming up in the upcoming future regarding the CIB. For this entire 12 months, everything is opened up for you. If we, our mini marathons, our mega marathons, or maha marathons, whatever we are conducting, everything would be available. The revision module is all yours in terms of all the subjects, right? So if you're planning for this particular examination, then hurry up, you can get it at 79% discount. That means actually if you go for the app, you will get for 80%. Along with this 80% discount, you will get double validity on our Mahapack. This is less costly as compared to the pack that you will buy. If you buy the 4 subjects, it will cost you around 500, 5,000 something. It is around, I think, 5,000 something amount. And then we are paying another 1,800 rupees. And then we are getting it for 1 year. That is for 6 months. This is for 1 year. And at the same time, you're getting all the optionals as well. So if you really want to invest, you should invest yourself in terms of the Mahapack, not only in terms of money, because money is something that you will just pay once. But in the next 1 year, what you can do is, rather than in 1 year, I would just suggest you the examination is in June. So make sure that you are putting each and every thing in certain way that you are able to finish your syllabus before time and you're getting the time for revision, because the examination is now very extensive and sometimes two specific exams are happening parallelly, matlab back to back. So you should be having enough time where you can pursue further in a proper manner, right? So, chaliye, now we are done with this part. Let's move on and talk about our subject. Here comes the first question, everyone. According to the fundamental method, how should the optimal multiple be selected? In terms of the fundamental method, how can we choose the optimal method? By choosing the multiple with the lowest association as to the worth of the company, by choosing the multiple with the highest association with the worth of the company, by picking a random multiple, or by excluding all the multiples except one. I think when we are talking about a multiple to be chosen, you should always choose a multiple which is having B by selecting the multiple with the highest association with the worth of the company. That has to be chosen. In the first edition of the security analysis by Benjamin Graham and David L. Dodd, which equity valuation method did they present as typical in 1934? 1934, which was the particular one which they gave? Is it enterprise valuation model and discounted cash flow, or price to earnings, PE ratio, or book value approach? In terms of security analysis, Benjamin Graham and David L. Dodd had given PE ratio. We've talked about PE ratio quite a few times now in the special class that I've taken. I talked about PE ratio a lot. There were multiple questions which related to this particular area, because PE ratio is something you just cannot avoid. You did it. This ratio was also done in terms of a ratio analysis in terms of your CAIIB AFM, but this is again continued. So this is not something which is not helpful enough. It is something which um, it is a very good parameter to understand the organizations. The next point is what determines the value of the trademarks. What determines the value of the trademarks and then copyrights, licenses in context with the independent and cash flow generating intangible assets. Acha everyone, it is a duration of the exclusivity. Then we have the physical characteristic of the assets, the number of competitors in the market, or the historical market trends. What's going to be the answer according to you? But then, I believe when is the time when I will be very renowned and I will be marking my presence in the market. For example, let me tell you a simple part of it. Uh, the simple part that I can tell you is, but then our specific area, no? There's a in the northern India you will find only in specific areas. I would say it's a particular area in the northern India that's called Tri-City. That is in the Tri-City basically includes Chandigarh, Panchkula, and Haryana, and Mohali. These are three different areas which are related to Chandigarh itself as a UT, and then Mohali is a part of Punjab, and then Panchkula is a part of Haryana. So this is in the Tri-City area, and there's a specific brand which came up, and that the name of the brand is actually Uncle Jack's. That's basically a specific brand of food chain which started with a very different ideology. They started coming up with their food in with this particular area itself. With They started giving the specific crockery for the same as well. They used to put all those things in the specific jars, and they were takeaway jars. They were simple, but Uncle Jack's was written on it, and all the information was given on it. So that particular organization really had a leadership in that particular market for a good amount of time. Reason nobody else was doing it. Till the time nobody else was doing there were jar cakes. The cakes were put in that particular jar in the specific series. Then at the same time, the food was very interesting because it was all westernized. It was more or less American food, which was with a little thing in terms of India as well, because ultimately we have to add that part. McDonald's survived in our country because of this. You have to bring something new in the market until the time you have that newness and nobody else can afford that newness. That is where you rule the market. That is the duration of exclusivity. Okay, so in this case the answer number one is the duration of exclusivity. But this is not answer number one, actually. This is question number third or fourth, you know. You really need to come up with all these ideas when it comes to learning the ABFM. ABFM is not something theoretical. Trust me on that note. It is such a practical type of area na, in terms of the specific organization. If I tell you, the IIBF has literally beautifully formed this particular examination. It has pure theory part. The first six chapters are effortless for anybody who has done management, who has done MBA. It is an effortless area. कुछ मेहनत ही नहीं करनी उसमें. The basic portion where everybody has to work, including the ones who are from the finance background. Now, I am myself from the finance background, but when your syllabus came, even I had to sit down and study what exactly was giving, because there are many chapters which are not a part of CA, which are not a part of CS. They were a part of CMA. CMA is Cost and Management Accountant. So they took up things from their module. They had taken up topics from the module of CA final. So when we talk about the way they are creating their examination, it's obvious you'll be baffled कि अरे what to do about it. But correlate things. Do not grab, and rectification should not be the approach, because till what time your rectification can happen? After a certain period of time, you will be so stressed out with the entire information that you will be putting up in your mind. In the area of management module, you will find a particular term called information explosion. Put so much of information and it's not solved in a proper manner, it will cause this issue, right? चलिए. I'm sorry. Let's go ahead and look at the question. And then comes, what is the potential challenge in terms of estimating the value of the copyrights and the trademarks? That's the next question. The unpredictability of the market demand, the absence of terminal value in most cases, then physical wear and tear of the assets. Copyrights and trademarks do not have a physical wear and tear. Then the level of competition in the industry. With the answer of this, Irana, see, when we talk about trademarks, copyrights, they're intangible assets. They have a specific life for which you will take that particular right from the market now. So that right is only for a specific period. So when it is only for that specific period, what will happen? After that particular period, it's just expiring. There is no terminal value that you'll be getting, isn't it? The absence of the terminal value in most of the cases. You will not find any specific terminal value. The terminal value or the scrap value is of cars. It is of the machinery. You will get something out of the scrap metal, but what will you get out of this? Just mere papers. You have just got it right and you paid for that. That is something which you will find that this is missing in this area. Okay, why is it challenging to assign a monetary value to intangible assets despite their significant value? Why can't we give that a monetary value? But in terms of, if you go back to the AS now, in accounting standard 26, that is related to the area of accounting standards which are given in India, they call this as a non-monetary thing, which is currently taken into the monetary value. Intangible assets do not generate any cash flow. They do, because we have goodwill, we have trademark, we have copyright. Uh, if I wear Adidas, why is Adidas and Adidas Originals having a difference in price? Think about it. Nike and all these good brands are totally different from other brands. They are capable of generating money for the business, and they generate good amount of money. Intangible assets are not subjected to valuation. Why? They are subjected to valuation. Companies are charging good amount of money because they make a good name in the market, and that's why they say it's time to encash that particular name. So it is subjected to valuation. Intangible assets are only subjected to assets are only have subjective value. Wish they could, but they do have a value. Intangible assets enable firms to charge higher prices, but their value is difficult to quantify. Now, that makes the answer. In terms of the entire area, you will find you go and buy a normal sportswear. Okay? If I go and buy a specific dress, right? Let's take it that way. I can buy a specific dress from a non-branded area, and maybe it would cost us 100, 200 even. If I go to Delhi and all those areas where you will find all these garments, then garment factories and all, it would cost cheap. But when it comes to, when you put up the tags, if I buy something which is related to the Adidas, Nike, if I If I buy a normal watch and then I buy Rolex, what's the difference? This is the difference. Intangible assets, they have a goodwill in the market and for which they charge a higher price because they made a mark in the market and they tell people ki we stand somewhere. You know? Actually, everybody who's there in the class, I request you all, please go ahead and like this particular session and share it among your peers. And please subscribe to the channel if you haven't done it yet. Okay. Next point, everyone. What does the discounted cash flow valuation approach entail when valuing intangible asset? Discounted cash flow valuation game, capital advertising expenses, discounting anticipated increase in cash flows, comparing market values of different companies, and the next point is the assessing of physical conditions. Everybody, what's going to be the answer? What does the discounted cash flow valuation entail? Discounted cash flow valuation does only one specific thing. What they do is, if you know what is the value which is going to come up in the near future, if for the first year it is 10,000, for the second year moves to, so first year it is 10,000, second year it is 20,000, third year it is 30,000. This is not the absolute figure that you will be getting. You will have to do the discounting factor and then you will make the mark. So then in this case, this is discounting anticipated increase in the cash flows because you will have to eliminate the part of discount which is included in it. Acha, what is the significant difference between the types of cash flows produced by the investments in real estate and financial markets? Real estate investments have limited lifespan. Financial assets are more volatile. Real estate investments are not affected by economic conditions, or financial assets have infinite life. What's going to be the answer? Significant difference between type of cash flows in real estate and financial markets. Financial markets are somewhat, they do not, financial assets are actually, real estate investments have limited lifespan. No, they don't. If I really have to be very clear about that part, real estate investments have limited lifespans. Uh, yeah, वैसे तो we can take it that way, but I still feel in this case we can also have the answer of the financial assets are more volatile. They are more volatile. Real estate is normally stable and it is normally increasing until or unless there is some blunder happen. Otherwise, it is always stable. Real estate investments are not affected. They are badly affected. During the COVID, they were badly affected. Financial assets have an infinite life. They just don't. Every company has an expiry date. You know that means in this case, C and D are definitely out of it. Then we are left with the A and B. Real estate investments have a limited lifespan. Acha, when we talk about real estate, if I think about buying a particular house, then that is for rental purpose. But then yes, after a certain period of time, that house will also become uh, in a poor shape as it is in use. And I think over the period of 30, 40 years, I would say, then we would need a renovation of that particular entire house altogether. So I would go for this. The correct answer to this area is A only. Okay, last question for the day, everyone. Why might the terminal value of the building in real estate be less than its current value? Buildings typically appreciate in value over time, they actually depreciate. The anticipated increase in the cash flows may not continue indefinitely. Uh, the land component of the building has an endless life. I think that is the correct point as well. Then the value of the building decreases as it's used. I think there is only one point which actually stands there. That is point number D, everyone. Okay. It's actually preparing multiple questions, so please avoid this particular serial number. The answer is D. You are using a specific place, and obviously it gets older. So once it's getting older, then the value of that particular building will definitely decrease.
Hello everyone, welcome to Officer 24/7. My name is Niharika Wale Bhatnagar and I'm with you with the era of ABFM. I hope you had been following us throughout the particular period. I have covered a lot of chapters with you, and if you like these particular series, then please go ahead and like the entire series. There's a couple of chapters, rather, the entire module A is done, entire module B is also done. I recently conducted a 2 hour class, which was basically a 2 hour special class during the Republic Day period. I think it was conducted on 24th. If you haven't watched it yet, it was actually based upon two particular chapters, rather three, four chapters, I would say. That is based upon that particular part where I've covered other discounted models. Then I've covered, I think, planning in it, right? So, special cases of valuation as well. So, we have covered a few chapters related to the module C because that is what I was dealing with recently. Along with this, I have also covered a part of the module A. So, this is what I've covered in the entire area. I hope you had been following me for that. If you haven't, then please go ahead and check it out on our website. Or best is to keep on following our YouTube channel. Subscribe to our YouTube channel as early as possible so that you can stay connected with me through it. And if there's any doubts or anything that you would like to share, please go ahead and write about it in the comment section. Till now, we are done with the specific area of Module C. Up to a level we are done. We are done with Module A completely, Module B completely. In terms of Module C, we were done with the first chapter, corporate valuation. Then we were done with the discounted valuation methods. Now we are moving on towards the non-discounted valuation methods. What do you mean by non-discounted? That means we are not considering one part, and that is time value of money. We're saying let's leave the time value of money beside, and they have specific models. What are the models that they're using? PE multiple, they are using PB multiple, they are using PS multiple, they are using PEG. So there are multiple formulas, multiple models in this particular area, and they are doing numericals in this particular chapter a lot as well. So doing the numericals, it will give you another level of exposure for this examination, because ultimately this is what is required from your side, that whenever you're doing all these questions and all, you are looking forward towards a specific area where you are able to basically get through this particular details of the examination in the best possible way. Before I move forward, please share this session among your peers, and don't forget to subscribe to our channel and like this particular video. Every time that when I see any of your responses, that's a very good source of motivation. Because when we talk about teaching online, one of the basic things that you miss as a faculty who's working is is there any appreciation that we will get from your side, right? Because that's the basic reason uh, we decide to work upon these things, you know. So when we're talking about this specific area, please help us out, keep on liking the particular sessions, because that's the first source of motivation. So let's move on and talk about it, everyone. um this starts with a very basic kind of valuation method, which is called, what is the first step of relative valuation? What do you mean by relative valuation? I don't know how many of you remember it, but I normally think about the term relative from what I did when we were in maybe ninth or 10th. We did a specific thing called that in poverty, we have two kinds of poverty. One is absolute and one is relative. Heard about this? Absolute poverty was related to the specific area कि देखिए, the person who's below the poverty line, then probably the people who are defined as कि these people are poor. And relative meant that relatively or comparatively these specific people are more poor. So when we talk about the relative valuation, this is related to our company being compared to some other company, where we are saying कि नहीं, both the companies are, in terms of the working, when we try to compare both the companies, one particular company is having more negative things than the other one. For example, if you are trying to buy a specific real estate in a specific locality, so what will you do? You will try to find out the
latest house that was being bought or sold in that specific area, so that you can actually find out whether when you are going for that particular property, is it really worth it or not, right? Identifying comparable companies, conducting research on the subject company, or analyzing the industry trends, or calculating financial ratios. What is the first step of valuation, everyone? I believe when it comes to the first step of valuation, it is going to be conducting the research on the subject company. That means always look at the locality in that area. If you're clear with that locality, only then it is going to work out. Otherwise, I don't think it's never going to work out, because ultimately we have to compare different organizations to find out the valuations. That makes the entire work clear. Otherwise, it becomes too cumbersome. Okay, now moving on to the next question. Why is it challenging to find identical companies for relative valuation? Everyone, if I talk about Coke and Pepsi, both the companies are somewhat, I'm sorry, they're in the same line. Then both the companies are working in the same area. Both the companies are equally big. But the taste, and PepsiCo has a different set of working than Coke. Coke reached out to every nook and corner of our country, didn't it? I think if I can find Coke in the most rural area, in the most basic grocery shop. But when it comes to Pepsi, you won't find it that way. It made its way to the showrooms, it made its way um, to McDonald's, it made its way to the Burger King, KFC, all those specific big food chain brands. It went to all of those, Taco Bell. I think everywhere all you can find is Pepsi and its um, bought cold drinks that includes Fanta, Mirinda. So technically, you can say that one of the organization had a separate structure and separate way of working, and the other one went into a different working altogether. So we have PepsiCo and Coke. So when we talk about Coke and Pepsi being compared, can we compare them right away? Companies tend to operate in a diverse range of industries. Now that's the problem. Coke is working in a different scenario while PepsiCo is into chips as well. If you have seen that, PepsiCo has Lay's, PepsiCo has um, uh, Lay's, they have Uncle Chips, right? These two specific brands are covered under them only, and they have got a lot of beverages. Coke has also got a lot of beverages. Both the companies and their structural as well as their tactical working is different. Companies have varying customer bases and operational scopes. Yeah, we do that. Coke has a separate customer base. Coke introduced Coke Zero, but then they had to take it back. Considering the fact in our country the malnutrition problem is way more. So technically, if the Coke is coming with sugar, it is way better to in a country like India. While when it comes to a country like USA, where obesity is one of the major issues of their uh, teenage population, right? For them, Coke Zero is a necessity. Then company operates at different capacity levels. Again, when it comes to Coke and Pepsi, they are serving different set of people. They are serving different set of people. They are serving at a different scale altogether, because in terms of the high quality restaurants and all, that is working in a different scenario. While when we talk about the Coke, it is reaching out to the lowest level, and both have a very different approach when it comes to work, though their advertising is very similar, and they understand that each other, that they both are competitors. So in this case, I can say all of the above are satisfying the specific area of corporate valuation. Now, why is additional research conducted on comparable companies after the initial list is created? To validate the analyst subject valuation, then to identify differences in behaviors of the multiple within the peer group, to ensure all the companies have identical financial ratios, or to create a ranking of comparable companies. Why is additional research conducted? Why do we do additional research, everyone, on comparable companies? Actually, we really have to do this, because otherwise we will not be able to study the differences. to identify the differences in the behavior of the multiples within a peer group. See, I think I just went overboard when it comes to Coke and Pepsi. You can go overboard to about other companies as well. Till the time you don't study them to ground level, how will you decide that which particular organization is going overboard and which one isn't? Isn't it? It is required, because if we are comparing two specific companies, we need to know where they are settling down in the same area or where they are not following each other. Then let's move on and talk about the next point. Why is earnings potential considered a significant factor in determining the investment value? Why is earning potential? Everyone, earning potential simply would mean what is the capacity that you think that you can earn more in the upcoming future, isn't it? Earning potential is irrelevant in the investment valuation. Earning per share is key driver in valuing securities. Cash flow is the primary determinant of investment value. Dividends have the highest impact on investment valuation. Uh, Listen, dividends has a specific impact, but I won't say it's the maximum, I would say, because dividend plays an important role. If I am an investor, this is one of the basic reasons that I put money into an organization. But this is a significant factor. No, cash flow is the primary determinant. I won't say cash flow isn't the primary determinant as well. Then the next point is earning potential is irrelevant, as well as EPS is the key driver. Earning per share, whatever the organization is earning, everyone, dividend is actually given out of the earnings. Yeah, na? First of all, we give something, and then uh, first of all, we'll earn. If we earn more, we can give more pocket money. If we earn less, how can we give more? So technically, in this case, the answer is B. Next point. Why does the analyst's job become more challenging when dealing in earnings that contain non-recurring and volatile components? Non-recurring components make valuation more straightforward. Volatility in earnings has no impact on valuation. It is easier to compare PE ratios across the different companies, and non-recurring and volatile components make less predictable and comparable. Um, Actually, there are many things which are non-recurring. For example, in one particular year, you can earn abnormal profits because you're absolutely new in the market, and maybe you won't be absolutely new in the different areas. And volatile components. Volatile means which are not stable. Market is never stable. These days, the market is changing like anything, isn't it? So, if the market is changing like anything, how can we predict that it's going to be absolutely fine in the upcoming future? So, in this case, I would go for non-recurring, uh, because non-recurring components make valuations more straightforward. It's not there. Non-recurring means they are not happening every single day. If they're not happening every single day, they cannot be considered, and they cannot be even anticipated what's going to happen in the future. So I won't say this is something which you will find. And then is volatility in earnings has no impact on valuation. Volatility has an impact, because if there is a major movement in the funds, people will feel that maybe if you have made an extraordinary money in recent times, maybe you'll make an extraordinary money in the future as well. That is going to create a problem. It is easier to compare PE ratios across the different companies. It's impossible. All the companies have one or the other difference, where ultimately it leads to a situation where people would say, and they would actually put an end to the entire situation, कि देखिए, this cannot be compared at all. Done. Chale, now let's move on to the next question. According to the survey by the Association for Investment Management and Research, what variable is identified as the most important when valuing the company's equity? Acha, when we talk about the company's equity, what do we mean by it? Company's equity simply means the company's money, cash flow, book value, the dividends, and price to earning ratio. PE ratio, uh, PE is basically MPS market price upon EPS earning per share, and MPS is market price per share. Cash flow, book value, dividend, and PE ratio. According to the survey of Association of Investment Management and Research, what variable is identified as the most important? That is PE ratio, I would go. No. Cash flow is not very important. It's an okay sort of thing. Then we have book value. I think when we're talking about investment, for this, I think I'll go with book value. Reason is that first of all, we would like to note at what price that we bought it. The rest is the fluctuations that we see in the market. And the fluctuations will determine our future, won't it? Acha, what limitation does the management face when altering earnings per share in accordance with the generally accepted accounting principles? Management has to complete freedom of to adjust the EPS. Adjustments to EPS have no impact. No, it's not possible. Leeway to alter EPS is unlimited, or management's leeway to alter EPS is very limited. I don't think when we talk about earning per share, any kind of manipulation is possible, because doing any kind of editing towards this particular area would cause a major problem, na? But yeah, that is true. Even that is why management's leeway to alter EPS is very limited. You can't play with EPS. The more you play with the EPS, na, the harder it would be to justify it later on. I don't know whether you have seen it or not. uh, okay, you must have heard about the Satyam scam. It happened a couple of years. I think it's been more than 10, 12 years or more than that. Maybe in 2008 to, it is between 8 to 15, I believe. It's old. It's an old scam in which the organization made a very difficult phase for themselves. What they did was they showed their profits 300 times of what it actually was. If you show more, you have to pay more dividend. And if you have to pay more dividend, you need more money. And if you're showing more profits, then you are paying more taxes as well. So technically, they thought that they could be able to save themselves, but they couldn't survive through that particular manipulation which they did. So the earning per share which they really this was changed, but they didn't go really long way. Ultimately, the organization crashed, and the seniors were behind bars, and they had to take the responsibility that yes, they were the ones who did that fraudulent work and changed the particular organization's working overall. That is something I would say this really has a very bad impact on the organization's working. So it's always better that the things are as it is, because ultimately more money being played with or manipulated, then the basic problem that happens in every organization is this will impact their working altogether. And it does, because they lose their market predictability and market credibility. Why is the book value often preferred over earning per share? अच्छा, when we are talking about PB multiple, पता है problem क्या होती है? What's the basic problem? When we talk about PE multiple, it is basically MPS. P is price of the share divided by earning per share. MPS upon EPS is good. There's no problem in MPS upon EPS. But the problem is if the company EPS is changing a lot, market predictability, market problems, we're facing a lot of issues. And what can we do? Our earnings are very limited. So then what will we do? We say let's compare the market price with the book value of the share assets. Now, if we compare with the book value, then things would be very easy. Book value is always higher than EPS. Book value is always more consistent, and it's always positive. EPS is not reliable financial metric, and PB multiple is not influenced by book value. Actually, book value is more consistent. The problem is EPS can also be negative now. Who says that the earning organization is always going to earn? They can face a particular situation that boom, they're facing a problem where they have to go backwards. So the book value is more consistent. It never goes negative. You cannot say that our net worth is this negative term. Negative term happens when the sick units, and sick units people don't really put money. These organizations face a lot of backlash, and then ultimately either they die or either they come out of that particular situation. But you cannot survive for a longer period with a negative net worth. Okay, here comes the next question, which says in situations with extremely high or low or very variable EPS, what may be more important than the PE multiple? Actually, this is very similar to the question that we did just now. PS multiple is related to the sales. Return on equity, that's a particular formula that is covered under ratio analysis. Then we have price to earning. PE multiple itself is creating trouble because it's not stable. If it is not stable, then you have to leave it out because it will give a longer term. Uh, I would say this is will give you a wrong answer. Price to cash flows, I won't say really the cash flows can be there. So I think if we have to really look forward to it, it has to be sales. Sales are quite a little more stable than this. The most stable is the book value though. PB is the most stable, while after that we have the price to sales and then we have the PE. Okay, so in this case the correct answer is price to sales multiple, everyone. You will see yesterday we finished up the topic of special cases of valuation. No, we finished up the other not discounted methods. Today we are pursuing towards special cases of valuation. We're talking about how do we value things. So on the basis of special areas. So let's talk about it in detail. Special cases of valuation. Matlab, what is the difference between the special cases of valuation and others? We're talking about it from the point of view of the business in such a way that we are talking about the different businesses. When there are different businesses, every business has a different kind of way of working towards it. Real estate has a different one, and the other businesses have a different way of working too. So the models and the working would be slightly different in the special businesses. So we have to look forward towards all those areas. And plus, this particular chapter also includes CAPM model. What do you mean by CAPM? Capital Asset Pricing Model. I always find this particular model very important for the examination. What is CAPM? CAPM says that is risk-free rate of return. If I am working in the specific field, I'm investing in a specific area, there's a risk-free rate of return. If there is no risk involved, there's a specific rate of return that I'll definitely make up. Then plus, what do we have? Risk-free rate of return. Then we have the beta. Then we have RM minus RF. Matlab, this is the market rate and this is the rate of the free risk-free rate of return. There is one area where we have risk and the other area we do not have risk. So technically, if we talk about this specific area, we are talking about risk-free rate of return, and then RM minus RF relates to the particular area where actually there's one more point, that is beta. Let me give you an example. This is too boring to explain in terms of the specific formula itself. Risk-free rate of return is basically say if there's no risk involved, I will make minimum 10% from the market. And beta is the sensitivity factor. For example, if the market changes by 10%, then our industry or our specific organization changes only up to a good limit, not the exact way. So then that is beta multiplier. Take it sensitivity that you have towards the industry or the external factors. It includes a lot of things, and I believe this can be asked in the examination this time as well. So we will have a specific beta. For example, if the market changes, we chase twice of it. So let's take it, the beta is 2. And then the market rate, including market rate always includes a risk area. According to that, it is right now at 16%. 16 minus 10%, what are we having today? It is 10% plus 2 into 6%. So this is going to be 10% plus 12%. It turns out to be an effective rate of 22%, everyone. This is your capital asset pricing model where you're trying to find the returns. Overall, this is your CAPM model, capital asset pricing model. The name of this model is capital asset pricing and model. Got the point, everyone? Simple, easy, and scoring. Acha, chaliye. Now let's study what are we going to do today. We are going to study about all these points. This was also there in this topic. I also discussed in the 32-hour special classes which were going on during Republic. Now go through that particular session. I've discussed all this point there as well. Okay. Acha. Now comes the next point, everyone. What is the primary challenge in terms of valuing intangibles? Acha, the basic problem is the special cases of valuation deals with the organization from this point of view as well. Acha, what do you mean by this, everyone? Matlab, I find this particular thing very interesting that in an organization which is this is something which is Intangible assets are non-monetary in nature. How can I value the goodwill? How can I value the specific relationship of any specific area towards the market? Isn't it? Can we do that? You know? So this is definitely a little difficult part. So how do we work in this specific area, everyone? When we talk about the entire area of intangible assets, goodwill, patents, copyrights, trademarks, super important. Determining their market value is difficult. Isolating the and assigning the monetary value or analyzing their impact on cash flows or comparing them to those are tangible assets. Actually, there is only one thing which is difficult, that is to find out their monetary value. They become a very strong reason that the organization changes a lot. There is a very strong way due to which the organization is able to value itself, because the point is, when we talk about the monetary value, it is very hard to find the monetary value of the reputation, trademark, copyrights. You create it, and individually to find it out is definitely a challenge. Okay, why might the capital investment approach not match the market value of the intangible asset? It is too subjective. It is capital investment approach is different from market value. It is based on discounted cash flows. Nope. It relies on historical expenditures, or it does not follow the accounting principles. Nothing can survive without following the accounting principles. Gone are those days where they could be very casual about it. So in this case, it is too subjective. The relationships are not very clearly defined, so then probably it becomes very difficult to find that particular part itself. And let's talk about the particular question now. What is the concentration in estimating the anticipated cash flows for real estate investments? Acha, real estate is here again. Historical trends in the real estate market, anticipated cash flows, length of asset lifespan, then potential depreciation of the market or level of liquidity in the market. But then when we talk about the real estate, now real estate is based upon the comparisons a lot. That means whatever is going in the market, we would go as per that particular area itself. But the point is, one particular thing which will always be dependent is what happens to the life of that particular asset. If I have a real estate, I have a building, but the older the building, the lesser would be the price I'll be getting. No doubt I'll be getting more money when it comes to the land. The value of the land increases, but the value of the building decreases. Now that's a major problem. So how do we work upon this area, everyone? For this, what do we do? For this, what we do exactly is we look at the length of the asset lifespan. We'll be looking at the length of the asset lifespan. What is a critical consideration when applying risk and return models? Market beta, diversification of marginal investor, risk premium, or variability of the returns? What's going to be the answer, everyone? The critical consideration that we are going to keep. What would be the answer? In terms of the applying risk and return model, but in terms of the working, you have heard about the term portfolio. Why would I put all the eggs in one basket? Why would I put my entire money into one particular investment area? Why won't I just spread it up in different areas altogether? It will really help us, you know. So when we are trying to do this, maybe this part may face loss, but these may have a positive. But that is a profit. So there is a diversification of marginal investor. ठीक है ना? Okay. Now let's move on towards the next point. Then, chaliye. Now let's talk about the next point. How, okay, there comes a CAPA model, everyone. Well, how is non-diversifiable risk? That risk which cannot be diversified, risk quantified in a capital asset pricing model. How do we do that? When we talk about risk-free rate. We talked about this. This is all the elements of CAPM model, isn't it? We talk about risk-free rate, beta, risk premium, and variability of returns. Do you remember this part? Risk-free rate, and then we have the beta, then we have the risk premium, and then we have the variability of returns. In this case, the answer is beta, everyone. The answer is beta. Okay, now what is the common argument against using CAPM model in real estate? Limited sources of real estate developers, overemphasis on risk premium, assumption of only non-diversifiable risk being rewarded, or high transaction cost is real estate. What's going to be the answer in this? What is the common argument against CAPM model in terms of using it in the real estate? But then when we talk about the real estate now, it's a very different mode altogether. There's only one specific assumption which is taken, and that is actually, see everyone, there is only one assumption of only non-diversifiable risk being rewarded. The risk that is being rewarded is non-diversifiable. Okay. Okay. Now, what is the concern related to the measurement of and utilization of risk parameters for real assets in asset pricing models? Diversification of investors, market beta accuracy, valuation principles, or issues in measuring betas. What is the concern related to the measurement and utilization of risk parameters? When we talk about the risk parameters are related to the market, to the scenario where we are trying to understand the portion of asset pricing. Now, this is talking about CAPM. Again, when we're talking about the CAPM, only one particular thing that we are worried about is issues in measuring the beta. The risks are too much and they are non-diversifiable. When they are non-diversifiable, it becomes a little difficult to understand that part. You know? So, issues in measuring the beta. What is the challenge in valuing the startups, everyone? What is the challenge in valuing the startup firms, especially those using new technologies? Lack of information on competitors, unpredictable cash flows, established history of earnings, or availability of financial statements. But when startups come now, I think there's an entire portion of the module D which talks about all these unconventional things in terms of the area of financial management. I'm sorry. So when we talk about this area, startups have a very major problem. They have lack of information on competitors. No, before you are entering the market, you will definitely rule, and you will try to find other things in the market. Unpredictable cash flows. No. Technically, this should be the answer because you just started your business. You don't know where would your business land. For example, I've talked about Nykaa earlier as well. Nykaa is basically an example of it's a website which is related to the area of cosmetics own earlier. Now it is a part of fashion as well. When this organization started, it provided all those unique brands which were rarely available in India. Rather, they were not even properly easily available. So they started selling all those good brands, and that too with authenticity. So women really liked that particular cosmetics that they were providing, and they were really of good quality depending upon what you're buying. So in suddenly the organization grew, and Katrina Kaif and Alia Bhatt also invested in this organization. And recently, I think it's been just a year, this particular organization went on board and got listed in SEBI. Um, it has now become a public company. During the time Paytm became a public company, it also became one. The difference is Paytm was still facing losses and still continuing to do that, while Nykaa became an organization which went way up. So these are all those firms where things are really unpredictable. It just starts moving. Uh, your organization will grow further or will fail. That is unpredictable in nature. You never know what's going to happen, isn't it? Okay, what is a primary assumption made by traditional risk and return models such as CAPM regarding the marginal investor? Uh, Marginal investor has a low level of diversification. Marginal investor is well diversified. Marginal investor only invest in real assets, or marginal investor has no exposure to market risk. The marginal investor. Oh, visible everyone? I hope it is. See, there is only one assumption that you can keep. Marginal investor cannot invest in real estate. I wish they could, but the point is the amount of real estate is slightly a little higher. Then the marginal investor is well diversified. That's what we'll do. If I cannot do this on my own, I'll have a mutual fund investor who will be taking my work, manager who will be taking care of the diversification, or I would be putting my money. And then I think in India we have these people less, but in outside India they used to have a lot of investors doing all this work for them. So technically, yes, they have this particular opportunity. So the answer to this question is the marginal investor is well diversified. Okay, what does the history of the company earnings and prices help in estimating? Predicted cash flows, competitors' performance, or company's valuation principles, or risk associated with the company. What is the history of a company earnings? See, if we look at the particular company, it has a specific history, and that too, in it has a very reputed history. Then what will happen? Then you come to know that this organization is actually a strong organization which has been working in this field from quite a long time. The reputation of that particular organization is definitely outrightly available, isn't it? So in this case, the answer is going to be risk associated with the company can easily be found out, they can easily be measured, right? The measurement of the risks are easily done because you have seen the history of the organization, you have studied the trend of their work, right? What might be the trade off when dealing with information constraints in valuing companies? Increase in one type of information and decrease in another. Increase in competitors' information, decrease in importance of financial statements, or decrease in historical stock prices. What's going to be the answer, everyone? See, when we talk about the trade-off, that's just basically just looking forward towards the balancing area. This is where whenever we have a problem with the information, whenever we try to work upon one specific type of information, the remaining type of information gets affected. So in this case, what happens is increase in one type of information would lead to decrease in another. That's one of the basic things. When cost of everything, you have a cost to everything. You want to increase one thing, you will have to focus something else. What is a primary determinant of the worth of a new company according to the section of startup firms? The company's historical performance, age of the company, the current value of the predicted cash flows, or availability of the goods or services. What is the primary determinant of the worth of a new company? Primary determinant is basically section of startup firms. Actually, that would be the history of performances does not available. It has just started. So technically, this is not possible. Age of the company is 0 to 5 years, where you can just not study about it at all. Startups are basically any organization which is up to 10 years of its age. So in the first 10 years, you cannot really expect something big happening. You must have heard about Book My Show, built in 1999. In 1999 to 2010, I believe, between that particular period for people, having a Wi-Fi at their home was a luxury. Many people didn't really have the phones even at that point of time. Their landlines and all were also very, they were not very common and popular. And at the same time, they were not affordable. When we were a kid, I think I used to see, all of us used to go to a cyber cafe if we really had to work upon the internet. So that's how we used to work upon internet, no? Right? So after I think 2008 onwards, slowly and steadily things changed. And 2011 became the marking area where 2G was introduced and people could access internet in a way better manner. So the age of the company couldn't really determine its success. Till 2011, nobody even knew much about Book My Show. But after that, people realized, कि, अरे, we can book the particular movie through that, or you can at least see which particular seats are available, and then we will go accordingly. Technically, Book My Show became um, a successful organization. I think the particular person who is the owner of Book My Show, he had a specific interview in which he said, someone asked that why did you continue, how could you continue a business for more than I think 10 years with almost no money that you were getting out of it. So he said, that was a very beautiful line. I think that is, I didn't treat my business like a girlfriend. I treated it like a wife. So that is how the particular treatment of the business happened, and Book My Show is now a successful business. So the age of the company really doesn't determine the worth of the new company, because its age is not that much, right? If it has been at least 15, 20 years, or I think when we talk about companies like Lamborghini and all, they have lived for more than 100 years. So there are certain companies, there are certain these motor vehicle companies which have been there in the market for so long, they are going good. So that is where you can talk about the age of the company. So the current value of the predicted cash flows, they do not have a fixed cash flow at all. This one is just predicted कि ठीक है ना, this can be the future cash flows, but this is not sure.
Hello everyone, welcome to Officer 24/7. My name is Niharika Walia Bhatnagar and I am with you with the area of ABFM. Acha, today we are starting with a very big chapter. This chapter is extremely important. The reason is mergers, acquisitions and restructuring is the biggest chapter of our book. In the module C, if I talk about ABFM, the biggest chapter is this only. Mergers, acquisition and restructuring not only has the area of finance, but it also connects this area with the company's accounts. Companies Act as well. Matlab finance area plus companies act, both are there, and we have to connect both the dots when we're talking about merger, acquisition as well as restructuring, right? So that's why this makes this chapter, the content is more. If the content is more, we expect good number of questions, though I think in the last two attempts I'd seen the same number of questions. They're not very good number of questions that has been asked in the examination, but decent count has been there. So I cannot say that you should leave this particular chapter, but yeah, we can take it as all the chapters in terms of ABFM had been asked in the examination in a balanced manner, not in a manner where it has been asked in a very frequent manner, but these all are asked in a balanced manner. Okay? But the complete book has been divided into different areas, and questions has been asked from different corners of the book. Now coming back to this particular area, we talked about mergers. Acha, what do you mean by merger? What do you mean by acquisition? And what do you mean by the term restructuring? Three different terms, but definitely three different important terms. Merger is basically one company, another company coming together and forming new company. That means A and B forming a company called AB. All the assets, all the liabilities of both the companies are now a part of this organization. This organization is not subjected to tax. Why? Because none of them are paying. AB is not paying even a single penny to A, single penny to B. Matlab, instead of shares of A, all the shareholders have now got shares of AB. The asset is not changing. Till the time the asset is not changing, there is no movement of money. How can we put an income tax on it? Won't it be wrong? है ना? That would be wrong. So that would be too wrong to have a merger where we cannot find this particular scenario. So what do we do now? Then that is a merger. There should not be any other money movement other than this. Then comes the term acquisition. What do you mean by the term acquisition? Acquisition means to buy or to acquire, to purchase any other company. If A purchases B, A becomes the parent company or the owner of B. Then comes restructuring. When the company feels, acha, everyone, if I feel my room is too boring, what will I do? I'll just change the seating plan na ki acha nahi, I think the bed doesn't go well here. I think I can change the place of the vase. I think we can fix up and we can make something else in terms of the wardrobes, right? Why won't we decide all these things? You know, we will. Of course, we will. Now, when we talk about the specificity
in terms of our um, company, then what will happen? We will change and reshuffle the number of shares, the shareholders, and the overall share capital of the organization. And we can actually ask one of the creditors or the different kind of debtor, debentures as well as other borrowings. We can ask them to make some changes in terms of the specific amount. ठीक है? So it is important that we actually work upon all these things. Every company requires certain change. For example, I hope you remember Vodafone and Idea has recently been merged together and they formed a specific organization called VI. You know, if they wouldn't have formed this, then what would have happened? Jio is already leading the market. Airtel has somehow survived, then both of these were left. If they wouldn't have become one, then was it possible to stay in the market? Airtel has possibly survived while it was a leader at one point of time. It's no more a leader anymore, but then it is still there. We still have BSNL going on. BSNL is something which I can say this is based upon, this is a government organization. They have still continued it. But when we talk about its existence and everything, they are not worried about that much. Though I think the existence of the organization has now become questionable as well, because ultimately now the country is looking forward towards where's the money coming from, be it any government sector or a private sector. That's the reality of the country right now, right? We have entered into an economy which is somewhat moving towards the capitalist area. So then when we talk about Vodafone and Idea, they had only one option. Either they merge together and cover up their losses, or they would be two different organizations which would be fighting for the bread and butter. Once they became one, they still had instabilities. They rather had good amount of instabilities, but they still survived and are still going on in the market. Now that is what we call about, right? Small things make a big difference. And whenever we are doing any kind of merger now, if there are two major organizations, just think about it. Coke and Pepsi are the leaders of all these beverages. What if both of them become one? Then they have a monopoly in the market. This is where Competition Act intervenes and it says, no, if you really want to do this, we need to review whether your mergers and acquisitions are going correct or not. That's also something which intervenes the entire working. So you can understand when we talk about mergers, acquisitions, and restructuring, this is not only linked with the area of finance. We are talking about not only the area of finance but also the area of law being connected to it. है ना? Okay, I'm sorry. Now, what is one of the primary reasons of for the reorganization of business? Technological advancements, globalization and increased competition, government regulations, or government environmental stability, sustainability. What would be the answer? What is one of the primary reasons for reorganization? Why would you make the changes? Survival of the fittest, everyone. Charles Darwin's theory. Till the time you don't change yourself with the changing times, you won't really survive, isn't it? To survive, you have to understand you have a lot of competition. If you won't grow, they will grow faster than you and they will replace you. So it's better that you keep growing and stay always on the first side. Globalization and increased competition is the reason that they have to do this. Next point, what is the form of external restructuring? Research and development, demerger, plant and machinery investments, or none of the above? When we talk about what is the form of external restructuring means everything is happening on the upper side, not in the exact organization. So in this case, what we're doing is actually demerger. That means from the bigger company, you take out a small chunk. This particular chunk is taken out and this is formed into a new organization. That's called demerger. Sometimes demergers are done to give one particular product an independence in the market. है ना? For example, I had a successful organization, but that successful organization is getting bigger and bigger, and I don't want to keep it as a part of my major organization. We are a group, so we said that let's give it an individuality. For example, Dove came out as just a soap. The soap which was having less pH value, that was not harsh on your skin, and slowly and steadily Dove became a specific brand of soft things. They introduced Dove lotions. They introduced the specific shampoos as well as conditioners. And after introducing the shampoos and conditioners, they didn't stop here. Then the next thing that they did was nothing. What next thing they did was introducing of the baby care products as well. That means this organization itself became so big that it gave itself a specific brand name. Maggie has a specific brand name, right? If I talk about Maggie, do you know Maggie is not only noodle area now? It has ketchup, it has a specific magic masala. Then it has ketchup, it has Maggie masala, our favorite noodles. It has pastas as well. All these things are currently available in our country. That means they itself are becoming brands. When you see that they are itself becoming the brands, and then it is your call. You can actually convert it into a specific organization that is called demerger. Next point. In May 2022, which two companies were involved in the significant merger related to the evolving technological landscape? This was given in our book itself, so that is what I can ask you about. This is basically what I can say is this is basically a question of data. When we have questions of data, they are covered here. Hinduja's Shaw, Wallace, and Ashok Leyland, or HDFC Limited and HDFC Bank, Mindtree Limited and Larsen and Toubro Group, or Chabria Group and Dunlop. This is given in the IBF book, so that's how this becomes a database question. Now the answer to this question is Mindtree and Larsen and Toubro. They joined their hands together. What what does the term absorption refer to in terms of merger and acquisitions? Legal dissolution of both the companies involved, creation of new company, transfer of rights and liabilities, or continuation of both companies independently. Absorption. Acha, what do you mean by absorption here? Let's see. When we talk about the term absorption, when one particular company exactly absorbs the other company in it, matlab the individuality of the company is gone. In demerger, what happens is we create an individuality and make it a full-fledged company on its own. While in terms of absorption, we are uh, absorbing one organization into our organization. There's a difference in this, na? Legal dissolution of both the companies involved, creation of new company, transfer of rights and liabilities, or continuation of both companies independently. Absorption simply means that the entire company is independently not working at all. Now it's a part of the other company. You know? Now in this case, this is legal dissolution of only one of the organization. Matlab this is A and this was B. So A is now a part of B. So that means this completely becomes A. है ना? For example, Tata Group added 1 mg into it has actually acquired it. I won't say it is absorbed, but it has been bought by the company. It had a lot of potential, and Mr. Ratan Tata saw that particular thing in it. He has a very foresighted vision, I would say. So this organization was taken over or bought by them. Danji, next question. What is the definition of merger? Basic term. Simple, sorted term. What is the common definition of merger? Dissolving business into to construct another, combining two or more existing business into single entity, acquiring the share capital of another company, or establishing um, a new company through the process of amalgamation. What would be the answer? What is the common definition of merger? The answer is combining two or more existing businesses into a single entity. AB becomes A and individually B becomes AB. Combining two or more existing organizations into one single entry. What type of merger involves two businesses operating in the same so there are different types of merger. I strongly believe types of merger is very important for the exam. Vertical merger, conglomerate, horizontal or hostile. Hostile is one of the mergers that I've seen in US a lot. In this case, what's going to be the answer? Vertical is basically I took over an organization which is under me. Conglomerate is we are in the similar area. When horizontal is about we are in the same industry altogether, and then we have hostile, you just buy the other company in a very aggressive manner. So in this case, when this answer is horizontal, because this is the same in line, same market sector, we absorb the organization and we grow further. है ना? Done. The answer is horizontal. Acha, what is the characteristic of conglomerate? Okay, here comes the conglomerate as well. Go ahead and look forward to the answer. The acquirer and target produce similar or rival products. The consolidation involves companies with connected fundamental technologies, or the goal is to eliminate competition and become monopoly, or the acquirer benefits from an expansion of the market participation. Done. So, what's going to be the answer? The acquirer and the target produce similar and rival products. The consolidation is basically connected, or they are not connected at all. What's going to be the answer? Conglomerate is basically when the consolidation of the company with connected fundamental technologies. You had some technological presence, which is good. The consolidation involves companies with connected fundamental technologies. The technologies of one company is so good that the other company wants to acquire it. अच्छा मतलब वैसे तो this is not happening, but let me just tell you. पता है the person I, I forgot the name, who is the CEO of AI. ChatGPT. The person who's actually the head of the ChatGPT, he was unfortunately removed by the board, and he was basically thrown into the organization. Matlab, he was actually thrown out of the organization by the board because of the opposition and all. So what happened was this particular organization was given to, he then ultimately was taken over by Microsoft, and Microsoft, we should be giving you the particular position. Then they offered him a position, and after a certain time, because of the pressure of the employees and other people, he was forced to being taken back into the chat gpt again. And this is how Microsoft and all this working also came into the consideration. Matlab, what if these two organizations come together and they form one particular collaboration? These are conglomerate mergers. This can happen, but though this didn't. So AI can be introduced at another level on Microsoft. That's an idea, isn't it? Those kind of things actually exist in the market. That is called conglomerate. If you have a technical know-how and it is helpful for me, then why not? Then what is the main characteristic of reverse merger? What do you mean by reverse merger, everyone? Normally we have heard that a small company that a small company is taken over by a bigger company. What if the opposite happens? What if the bigger company is taken over by the smaller company? Smaller company has a lot of money, but it is not able to reach out to the share market. It said, let's buy the bigger company, and then the bigger company already has an access to the market. So why not? A smaller company acquires a large or publicly listed company, or it involves a purchase of controlling interest in the share capital. The acquirer and the target have a buyer-seller relationship, or the acquirer company loses its identity. Nothing of that sort happens. When we talk about a reverse merger, the smaller company, reverse means what? The smaller company will buy the bigger company because this bigger company has the right to access the money from the public. So in this case, what's happening is this bigger company would do the work for the smaller company in terms of the funding. It will bring all the fund that is required by the smaller. A smaller company acquires a larger public listed company so that they can actually gain money through it. How does a reverse merger help an unlisted company? Uh, by acquiring a conglomerate, by eliminating competition, by avoiding the IPO process, or by providing a vertical merger. The bigger company already has an access to the share market. So technically, what is it doing? It is providing them IPO on its own. It's a ready-made process which they are getting. Otherwise, it would have been a very much troublesome issue for the business, isn't it? What is the alternative option of acquiring firm when it acquires another company? Vertical merger, conglomerate, uh, combination into a single company, or running independently, or elimination of competition. Alternative option of for the acquiring firm, uh, when it acquires another company. When you're trying to acquire another company, then one thing that is happening is combination into two or more entities. You can also combine the two entities and give them their individuality and then keeping that alive. So that would be the answer in this case. So that's it for the day. Acha, before I proceed further, everyone, first of all, if you haven't uh, downloaded our app yet, then it's high time. Go ahead and download it because we are bringing up with so many um, batches for you. There are different things that is being planned for the entire batches. So please utilize this opportunity for your benefit. Okay, so go onto the website, that is www.adda247.com. Once you go onto this area, then what you need to do is go onto the area of JIB and CIB. Once you go onto the area of JIB and CIB, look at this CIB June 2024. This is the examination when it would be conducted. All you need to do is look at this particular area, the resolution batches here, that is the English medium batch. What you can do is, this is only the BFM which is visible. What you can do is you can actually buy any specific exam, or you can buy the entire, that is CIB Mahapack 2.0 can be bought by you, which includes all the specific classes. All you need to do is go ahead and use the code Y541. As soon as you apply this particular code, then you will get it at 79% plus 1% if you are buying through app. That means overall 80% discount is available to you. So plan out to buy the Mahapack, because under Mahapack you get a lot of things: English medium, bilingual, both the classes open, every single class of CIB, whatever we are taking, every single class would be opened up for you. There is no restriction if you buy this particular pack, and that too for 12 months you have this particular opportunity. Then this isn't this better than any other subject specific, because optional subjects all 5 are covered, all the 4 compulsory are covered, test series is covered, video courses as well as live classes both are given to you. है ना? So all these things are available for you. Then please go ahead and check it out on our website or in our app for further details.